If you sold your property for a $100,000 profit, you do not have to give the IRS $20,000 of it. I'll explain how. So let's just go basic numbers and say you bought a property for $100,000 and sold it for $200,000. Normally, the IRS takes 20% of that, so you would walk away with $180,000 of your $200,000. That $200,000 is just gone. But with a 1031 exchange, you can take that full $200,000 and roll it into your next property without any tax, at least not yet. So you can keep that $20,000 working for you instead of working for the government. And then when that property appreciates and you sell it, use another 1031 and roll it into the next property. And if you do this for decades and decades, you will build so much compound interest on your sales and your capital working for you that yes, at the end you will have to pay your taxes at some point, but the amount of money you will have will be so much more than if you paid your taxes earlier. That's the difference between building wealth and then making money. Now there is a catch. There's no free lunch. The IRS only gives you 45 days to identify your next property and 180 days to close. So you do have a quick turnaround. If you miss those windows, the exchange dies and the tax bills arrive. There are some other things you can use like cost segregation and various different methods. If you want to actually learn about those, I found these guys called the cost segregation guys. I'll put their name down in my caption so you can know their name, but they're pretty good. I think they know what they're doing.